Hello, everyone. My name is Yoav Waxman, and I'm a professor of economics at Coastal Carolina University. Today, we're going to talk about money and monetary policy. Let's begin with a definition of what money is. Money is a medium of exchange, a measure of value, and a mean of payment. Money serves three different roles. It is a medium of exchange, which means that we use money to buy things, and it's generally accepted by everyone. It is a unit of account, which means we use money to compare the value of prices of different items. And finally, it's a store of value, which means that we can save money and use it in the future. To illustrate these three basic points, let's look at a couple of scenarios. Suppose that my goal is to buy a house. So the first thing I do is I start saving money using a certificate of deposit. What role is money serving in this capacity? Please pause the video and give me an answer. The role is a store of value. A store of value is anytime money is used to store value and use it in the future, such as saving for retirement or a house. How about when I'm ready to buy the house and I'm comparing the prices of different houses? You probably have the correct answer. It is a unit of account. A unit of account, again, is when I compare the value of prices of different things using dollars, euros, or another type of currency. Finally, when I'm ready to buy the house, I wire the payments for the down payment. In this case, I'm using money as, you probably got this one, a medium of exchange. Medium of exchange when I use money to purchase things or settle a debt, and it can be done by direct payment of cash, using a debit card, writing a check, or wiring money. So money has different forms. And it's important that we understand what these forms are. Money can serve as a commodity. In other words, something that people use on a daily basis. In fact, the oldest forms of money are commodity money. In Egypt, they use grain. In Sub-Saharan Africa, they use cattle as a form of money. In the Roman Empire, they used salt, which is where the word salary comes from. And salary comes from salarium, and salarium was used to preserve meat. Then you have token money. Token money are things like gold, silver, jade, that we don't usually use on a daily basis, but they still have value. Representative money is typically paper money that represents something else of value. Until the 1970s, all US dollars were convertible to gold, which was called the gold standard. Fiat, also pronounced fiat money, is money that's not represented by anything, but is only backed by government promise. Electronic money, which is what most people use these days, is not even physical anymore. It's basically encrypted digits that can be converted to physical money by, for example, going to the ATM and taking cash out. And finally, cryptocurrency like Bitcoins or Litecoins are not even backed by the government. They are created by programmers that often refer to themselves as hackers using technology called chain block. So money can also have specific characteristics. Certain things work really well as money and other things do not. Money should be durable, which means last a long period of time. Money should be portable, which means we should be able to carry it easily from one place to another. Money should be divisible, which means we can break money into small units. Money should be consistent, so one unit of money should be about the same as another unit of money. And money needs to be relatively scarce, which means it's not extremely scarce. We need to use it regularly, but it's not something you can find everywhere. Bearing that in mind, let's look at the set of problems right below over here. And you can tell me for each one of these, what characteristic of money does this specific commodity not meet? So let's think of Honda Accords, a type of car, sand, and tomatoes. For each one of this, stop the video and tell me why they will not be a good form of money. For Honda Accord, the answer is it's not divisible. It's portable, it's durable, they're pretty standardized, but we cannot break up small units, so you can't really go into the supermarket and buy milk with them unless you cut off a part of the tire, which doesn't make any sense. For sand is divisible, consistent, right? But the problem is it's not scarce. So if we use money as sand, everyone can go to the beach and dig as much money as they want, and money will become valueless. Tomatoes are somewhat scarce, but the problem is, of course, is that they're not durable. So in order to be an effective form of money, money has to meet all 5 characteristics: durability, portability, divisibility, consistency, and relative scarcity. Let's shift over to the right side of the screen. First of all, we need to find out what liquidity is. Liquidity is defined as how quickly and safely we can convert an asset into cash. An asset is something that retains long-term value, includes cash itself, but also funds and checking accounts, stocks, gold, and even land. These are all assets. When we think about liquidity, we can think of liquidity along a scale. The most liquid asset is, of course, cash. It already is cash. It doesn't need to be converted. But very similar to cash is funds in checking accounts. Checking accounts can be converted to cash very quickly by taking them out of the ATM, using your debit card, or, of course, writing a check. Savings accounts are a bit less liquid because they typically require a minimum to be kept in the account, and they may have additional restrictions. CDs, or certificate of deposits, are even less liquid because they require the owner to keep the funds in the account for a given period of time. So a CD might be for a year, or 5 years, or 10 years, and the longer you keep it there, the higher the interest rate that you get. But if you take the money out early, you pay a penalty. Money market funds are also being offered by banks, and they invest funds in a variety of safe assets like small CDs or treasury bills. Bonds are less liquid, but because if you hold on to them, you will get your money back. But if you sell them early, you can lose some of the money. Gold is less liquid still. And you may think gold is equivalent to money, but it does fluctuate in value quite significantly, as do other minerals and metals. Stocks are even less liquid. They can be converted very quickly to cash, but you can lose money very quickly as well. And there are other things like commodities, and one of the most illiquid things is land. Sometimes it takes years or even decades to sell a piece of undeveloped land. We can lump these into M1 and M2. M1 is considered cash or cash equivalences, includes cash, money in checking accounts, and also small things like travel checks and money order. M2 is a broader measure. It includes everything in M1 plus saving accounts, small certificate of deposit, and most money market funds. Bearing that in mind, think about these two scenarios and tell me what's going to happen to M1 and M2 as a result of these actions. If you use money from a checking account to buy a CD, pause the video and figure out what happens to M1 and M2. The answer is that M1 will decrease because you took the money out of your checking, but M2 will increase. To see this, you can actually follow this arrow over here, right? This arrow is a little bigger than I wanted to, so I'm going to use a smaller arrow. Here we go, in yellow. And you can see that the money is left M1, but never left a big circle, which is M2. So M2 remains the same. Let's look at another scenario. In this scenario, you sell your stock and you put your money in a savings account. What is that going to do to M1 and M2? Pause the video. If you answer the question correctly, you would say that M1 will remain the same and M2 will increase. To see why, let's file the error again. Stocks are neither in M1 or M2. So you put the money in M1, there's no effect in M2, there's no effect in M1, so M1 remains the same, but M2 goes up. And you can consider other scenarios as well. Next, let's talk about the Fed. The Fed is a very important institution. It serves as a central bank for the US government. And the Fed has 4 very important roles. So zooming in on the roles of the Fed, we know that the Fed acts as a central bank for the federal government, but not state and local government. It regulates the depository institution, which refers to commercial banks, but also credit union. Credit unions are typically smaller. They're owned by the members and are often restricted to a particular group like teachers or state workers. The Fed also serves as a lender of last resort, which means that if banks have an emergency and they cannot get money from out of the bank, they can reach out to the Fed and borrow money directly from the Fed. And finally, the Fed manages our monetary policy, which is the most important role that the Fed serves. So what can the Fed do when it comes to monetary policy? It turns out the Fed has a variety of tools, and let's examine them right over here. The Fed can lower or raise the required reserve ratio. This is something the Fed rarely does, but they can do it if they want to. The required reserve ratio is the ratio of deposit that banks have to hold in the vault. If the required reserve ratio is higher, banks have to hold a higher amount in the vault and therefore can lend less money. The less money banks lend, the less activity there is in the economy. The Fed can lower or raise the discount rate, which is the rate that banks use to borrow directly from the Fed. But you have to remember the Fed is only a lender of last resort. So banks are encouraged to borrow from one another instead, and therefore pay what's called the federal fund rates, which is the key interest rate for the United States. If either the discount rate and the federal fund rates are raised, it's going to be harder for banks to borrow money. Therefore, they're going to borrow less money and make fewer loans themselves, which will slow down the economy. If we lower the discount rate and the federal funds rate, and the Fed usually move those two together, it will make it cheaper for banks to borrow money. They will borrow more money and therefore have more money to lend. Finally, and this is connected to the federal funds rate, the Fed can buy and sell government bonds in an open market operation. The Fed buys government bonds to boost the economy because when they buy bonds, they give banks money. And that money can be used to make loans. Loan for businesses, loan for individuals, which will stimulate the economy. And they sell bonds to slow down the economy because when they sell bonds, they're taking money away from banks and banks have less money available to lend out. That being said, these transactions are completely voluntary and the Fed cannot force banks to buy or sell government bonds. Bearing these tools in mind, we have 2 types of policies. An expansionary policy occurs when the economy is struggling and the Fed is trying to stimulate the economy. A contractionary policy occurs when the economy is doing well and the Fed is worried about inflation. Inflation deteriorates the value of money and also decreases real wage and real interest rate. So looking at these scenarios, tell me what the Fed can do in each of these 2 scenarios. If unemployment is 7% and inflation is 1%, what would the Fed likely do? Please stop the video and answer the question. The answer is that the Fed will use expansionary monetary policy because the economy is struggling, unemployment is too high. The ideal rate of unemployment is 5% or lower. Inflation is under control, so there's no need to worry about money creating too much inflation. They can, for example, lower the required reserve ratio, which would be unusual, but a pretty significant measure. They can lower the discount rate, they can lower the federal funds rate, or they can buy government bonds from banks to stimulate the economy. How about the second scenario? Unemployment is 4%, inflation is 4%. Please pause the video and answer the question. If you answer the question correctly, you would say that the Fed would use a contractionary monetary policy. It may look like employment and inflation is the same, but the target for inflation is 2%, where the ideal rate of inflation is 2% or lower. The ideal rate of unemployment is 5% lower. So in this case, we have a low unemployment, inflation is too high. The Fed is going to use a contractionary policy, and they can do things like raise the required reserve ratio, which would be, again, a very rare thing for the Fed to do. They can, of course, also raise the discount rate, raise the federal funds rate, which you usually do together, and they can do that by also selling government bonds to banks and taking away some of the money from circulation. So I hope that you enjoyed this lesson. If you have any questions, you can email me at yoav@coastal.edu, and have a good day.